Hi, I'm Maryam Akram, a research principal at Chartis. Thanks so much for joining us for the first day of Chartis Storm event. Today, we'll be discussing navigating fund liquidity risk. Of course, liquidity risk has been top of mind for many stakeholders across the financial landscape as interest rate volatility impacts investment performance, client behavior, and much more. Liquidity risk is an ever-present challenge for investment funds and one that can have far-reaching consequences for both investors and the broader financial system. So today I'm joined by two panelists. Yury, if you would like to introduce yourself, and then Lou, and then we can get started with the discussion.
Sure. Good morning. Yury Dubrovsky. I recently retired from Lazard. I was Chief Risk Officer for their asset management division as well as the corporate. At the peak, about 282 billion under management. I've spent about 30 years on Wall Street, split about 12 years on the sell side, 18 years on the buy side, worked in technology before, so I think have a good grasp of both financial and enterprise risks.
Hello, everyone. My name is Chang. Like Yury, I have a combined experience in the sell side and buy side. I spent the first 11 years of my career at one of the largest banks in the United States, Wells Fargo, working in a number of different risk management roles. Now I joined a hedge fund in Atlanta that at a peak of it has a $10 billion AUM, followed by a firm on Wall Street, Axonic Capital, where I served as the Chief Risk Officer and responsible for all aspects of risk management.
Great, thank you so much both. The first question I'd like to kick off with today is, how does the composition of an investment fund's client base contribute to the unique liquidity risk challenges for these funds? Lou, if you want to get us started on this one.
Yes, absolutely. My firm has a package of different portfolios, both in mutual fund and in hedge fund. I'll say the retail investors are more likely to panic during the market downturns than the institutional investors. And even among the institutional investors, I can see a different behavioral pattern. For instance, pension funds and insurance companies tend to have a little bit more long-term horizon and less likely to redeem from us during downturns. But hedge funds or other more short-term strategies can be more opportunistic in their market decisions.
Interesting.
I think from my standpoint, we always looked at client concentration, irrespective of the type of fund. I think it's important to understand your client base, and if it's crowded, it's of course even more important. Even prior to Silicon Valley Bank, which again it's a sell side issue, but understanding your depositor base, understanding the type, they all belong to the same type of an investor, and they were quite sizable. So diversification across investor base is very important. And I think it is important, and I think we're going to talk about it more a bit later, but ability to stress test. I think a firm should have a view on both investor concentration and when it's too much, right? That you have sort of correlation between capacity and investor base. And if too many investors are going through the same door at the same time, there will be pressure to sell or pressure to redeem. So knowing your client base, and if your client base is very diversified and patient, maybe that could actually positively impact your portfolio construction and generate sort of new sources of alpha.
Interesting. So diversification, understanding time horizons and run risk all sound critical there. My next question is about what strategies can investment funds employ to mitigate liquidity risk, particularly during periods of market dislocation, like you just mentioned. So, Yury, if you want to get us started, and then Luke can follow up.
I think there are quite a few approaches. Not all of them are my favorite, to be honest. For example, gating is one option. Ability to limit redemption to X% of your investment per quarter is another option. But to be honest, it creates other reputational risks. And when stress comes out of the market, clients remember that. and clients will remember that you created pain points for them. And my old CEO used to say this is a death nail. I don't know if I would call it a death nail, but it's basically definitely negative sort of reputational risk. I think it is important for funds to have backup credit facilities. This is not the deployment of choice on a regular basis, but if there is a significant stress in the market, if you do not want to gap your mark to market 25% just because everybody's panicking, I think having a backup credit facility across your platform is a very good choice of dealing with it. But at the end of the day, it's about portfolio construction and ensuring that asset liability mismatch does not exist.
I agree with all the above. In addition, for instance, I feel like a fund structure is really important. For instance, for hedge fund, gating is obviously, if you gate the fund, then you eliminate the liquidity risk altogether. But it's also like a case of death, right? That's the last resort that you wanna reach out for. But if you structure the fund really well, for instance, you put the less liquid assets in hedge fund or even closed-end fund or interval fund, but a more liquid asset class in daily fund, that is a good alignment, especially when it comes to regulatory risk. And also, I feel a timely and consistent liquidity analysis is really important. For instance, we analyze each and every bond holdings, if you will, in terms of liquidity status, right? We bucket them into the 4 buckets according to the SEC definition. But the bucket itself is not that important to us. It is the change of the bucketing, from time to time that catch our attention. So we focus our attention on the ones that requires us to understand what has changed when it comes to the liquidity status of each holding. That helps a lot. And also, I can agree with Yury more about the line of credit. Not only we have line of credits, we have some specific line of credits that I personally found very useful when it comes to risk management. For instance, most funds would use repo as a line of credit, right? It is a source of liquidity that will go away at the time of crisis for no reason or any reason, because when the liquidity becomes tight, everybody will, stop giving you cash. And so it's sort of not very useful. The kind of line of credit that we use is, first of all, not mark to market. Because at time of crisis, when the creditors start to mark our collateral really aggressively, and that reduces our source of liquidity quite significantly. And also, they tend not to give us additional lending at the time we really need it. But non-mark-to-market line of credit hedge against that kind of risk. The second line of credit is by our fund administrator. This is a tool made available to us by our fund administrator. They're really not the traditional lenders, if you will, but because we're their client to make us happy, they will this line of credit to us. It is completely redemption related because they actually see the redemption coming in because they manage our funds for us, and they gave us the exact amount of the redemption so that to alleviate the stress for us to have to liquidate the holdings, if you will. Last but not least, cash buffer, right? Nobody likes to hold cash, especially when the cash return was almost zero. But nowadays, to hold cash actually gave you a pretty handsome, 5.5-ish return. So it is really not a bad idea to keep some cash on the side to manage liquidity.
Can I just add, I think these are very important points. Just one more point, I think, to add. For hedge funds, they all deploy leverage, so rehypothecation is standard practice. We know what happened, or remember what happened in 2008. So a lot of long-only funds, especially in the mutual fund form, do not do security lending, so they don't allow actual rehypothecate the assets. So that choice of getting credit in the repo format is not necessarily there. So depending on the type of a fund, depending on who's standing by you, hedge funds have prime brokers, have administrators. Mutual funds don't necessarily have a ready-made credit line unless they request it. and prepare. So I think one of the most important thing is prepare for crisis, even though crisis might be far away. Sure,
that makes a lot of sense. Switching focus a bit to specific asset classes. Yury, I'd love to get your take on this. The IMF recently warned that the private credit market could pose a systemic risk in the future. How do you think private credit might contribute to liquidity risk going forward, and what preventative measures can be taken?
I think this is a very interesting topic because now retail is becoming interested in private credit. I don't know if people realize that the amount of money available from baby boomers retiring is much greater than public securities market. So basically, private markets are becoming much more important, but given the interest, given the amount of money, sort of supply and demand of money available, privates are just becoming, so private credit existed for quite a long time, but it's becoming mainstream. I think in regular portfolios, it's around 7%. This is actually the number I heard from the IMF. But if you're talking about insurance companies, apparently they have about 3 times that. So 20%. So I think it's the concentration risk within certain portfolios within a particular asset class that not everybody understands and knows about is I think the question to be answered. I actually did listen to IMF interview, representative interview, deputy IMF director, and he basically said we don't have enough data, so we sort of driving blind. So until we have enough data to determine the quality of the asset class and to ensure that covenants are there. So I think we're going back to prior 2008, where people were talking about cov light, right? This is credit. So your underwriting quality is becoming much more important. If you listen to an interview from Ares Capital Management CEO, Michael Arangetti, I think he said, our default rate is 1 basis point in our portfolio. Jamie Dimon is talking about private credit becoming systemic, as well as others. So I think knowing the data, right now it's the fear of the unknown. Private credit has not proven to be a systemic risk yet, but if we have too much money chasing one single idea and it becomes retail focused, this is where we might create unnecessary panic, and it will be blamed on the asset class rather than on the investor behavior. So I think regulators are paying much more attention, which is the right thing to do. But the first step is to find the right data that can actually make them, help them make informed decisions based on that, and not just overregulate immediately.
Yeah, I think lack of transparency is a significant dynamic here. Thank you.
I think a very interesting point that Yury just touched upon actually is related to our first topic, which is the client concentration. You know, sometimes even if your client concentration is not there, they are not concentrated from a structural point of view. If they are all chasing the same idea, or if they all follow the same investment advice by a larger financial advisory firm, they still could move in tandem, and that is a liquidity risk as well.
Great.
Sure. And Lou, how important is stress testing in liquidity risk management, and what best practices should funds adopt in conducting these tests?
Obviously, it's very important. I feel like it's a front and center when we try to analyze the liquidity of our portfolios. So I think the first consideration really is what is appropriate past market event that is most applicable to your type of funds, right? Be it structured credit or equity or fixed income. The reason I emphasize that was because when I first started at my firm, I was given a number of stress market that is S&P 500 measured, meaning what is a downturn is defined by if S&P 500 decreased. But the thing is, we are a structured credit fund. So we're not highly correlated with equity market. Some of the downturn, we actually produced a pretty handsome return, if you will. So making the stress testing impossible. So what I did was we basically combed through all the past so-called market crashes for the past 20, 25 years. And we identified about 15 of those in the big or small. And then we try to identify those that are most applicable to credit fund, right? Such as the start of 2016, the beginning of 2018, the taper tantrum, etc. So we identified 5 to 6 of them, and that is truly real stress for us. So I think that is a very important foundation for any stress testing to begin with. And then on that foundation, we update all liquidity sources and usage, such as margin calls, encumbered assets, committed purchases, etc. It sounds like pretty straightforward, but in practice, it takes a village for that to be effective. For instance, from where I sit as a risk manager, I don't see the committed purchases all the time, right? Because we don't have a system capturing those. So it takes a collaboration between the trader, the CFO, even the operations team to make sure that the major moves are reported to me so that I can reflect that into my analysis in a timely fashion. And lastly, assess all of the above collectively, so to assess the fund's ability to meet redemption through different scenarios is basically the outcome of an analysis.
Interesting, thank you. And I think we only have a couple of minutes left. So Yury, if you'd like to close us out, maybe give us your take on what you think the future of liquidity risk is. That can be from a regulatory perspective, market dislocation events, things like that. Go for it.
Well, I think liquidity risk definitely will not go away. And I would suggest to risk managers and everybody else who's focused on making sure funds and any investments work properly, do not hide behind top-down numbers. If you're paying attention to Tulu's point, S&P, if you're paying attention to VIX, nothing is happening. But there is so much rotation under the hood, whether it's in equities or any other asset classes, hiding behind saying commercial real estate will have problems where data centers actually might do well, right? So I think granularity is very important. Having ensure basics are working, but in the case of liquidity, reaction function cannot be fast, which means you need to be prepped much earlier. You need to have the right systems in place where you can change the dials in your stress testing of liquidity. But chasing the latest sort of news and trying to understand liquidity if you're not prepared for that is very difficult. So I think it's a risk that will stay with us. It'll probably become more complex because we have more data, and now we need to deploy that data, but also ensure that we don't have garbage in, garbage out.
Sure. Great. I think that might be all we have time for today. Thank you everyone for joining. If you have any questions, please feel free to email in. Yury and Lou, thanks so much for your time. Great insight. And, I think we've really emphasized the importance of monitoring your liquidity risk and preparing for the worst.
Thank you.
Thank you.
Thank you for having me.